Ever wondered why the head and shoulders pattern is such a big deal in trading circles? Well, it's time to satisfy that curiosity. Welcome to another insightful session where we demystify the complex world of trading. The head and shoulders pattern, a staple in the technical analysis realm, is a reversal pattern signaling a potential shift in market trends. Imagine a person's head with two shoulders on either side. That's precisely the formation we're talking about. Its uncanny ability to predict trend reversals makes this pattern a favorite among traders. Now, how do we identify this pattern? It's simple. The classic head and shoulders pattern emerges at the tail end of an uptrend, showcasing three distinct peaks: the left shoulder, the head, and the right shoulder. The left shoulder forms as the price climbs and then falls back. The head, the highest peak, comes into being as the price hits a high and then drops. The right shoulder forms when the price ascends again but doesn't quite touch the height of the head before falling back down. The neckline is the line connecting the lowest points after each peak, but there's a flip side to this pattern too. The inverse head and shoulders pattern, which appears at the end of a downtrend, signals a bullish reversal. This pattern features two lower troughs, the shoulders, and the lowest trough, the head. The neckline is drawn across the formation's highs. A break above this neckline confirms the shift to an uptrend. Spotting the pattern is one thing, knowing how to trade it is another. Traders often enter a short position when the price falls below the neckline after the right shoulder forms in the classic pattern. For the inverse pattern, a long position is entered once the price breaks above the neckline. Remember, the neckline breakout is the pattern confirmation, so you'll want to wait for this to avoid false signals. Always keep in mind, trading is not just about making profits, it's also about managing risks. Set stop-loss orders just above the right shoulder for the classic pattern and just below the right shoulder for the inverse pattern. This action protects against potential losses. And remember, no pattern guarantees 100% success, so tread with caution. Now let's look at some chart examples. Notice the pattern formation and the subsequent neckline breakout. Analyzing past patterns will help you spot them in real-time trading situations. So there you have it, the head and shoulders pattern, a potent weapon in your trading arsenal. Practice identifying this pattern and weave it into your broader trading strategy for more informed decision-making. If you found this guide helpful, don't forget to like, share, and subscribe for more trading insights. Until next time, happy trading.